Hi, this is Randy Finney with Right Side of the Chart, and tonight is Wednesday, January 18th, and what I wanted to do was a quick market update, sort of a big picture overview of where I see things, where we stand today. I think we're at a pretty critical juncture. So what I'm going to be talking mostly about tonight is the S&P 500. I'll actually be using the SPY, the tracking ETF for the S&P 500. That's my preferred charting vehicle. Okay, so what we're looking at here is a monthly chart, meaning every candlestick bar here represents 1 month in the market. And this is actually a 24-year span on this chart. The blue line is what I've had it marked as a primary uptrend line, and within that primary uptrend line I have what I call these sub-uptrend lines, or sub-trend lines, up or down trend lines. Sometimes I'll draw either way. I could put a downtrend line here. And as you can see, this was the tail end of the great bull market leading up into the tech bubble that burst back in 2000 and the subsequent bear market. Then we had, of course, another bull market, which lasted up until October, depending on what index. In the S&P, I believe it was October of 2007 where we peaked. And, of course, that bear market officially, at least in my opinion, started back then in early, well, broke the trend line, I should say, in early 2008. And then sometime during that meltdown is when we broke this multi-decade primary uptrend line, which, in my opinion, helps confirm the fact that we are in a secular a secular bear market, looking at the big picture. And of course, that's backed up by other evidence as well. Now, what you're looking at here, this is a double top pattern on the S&P 500. We put in equal peaks, and the market has to this day not been able to get above that high that it put in back in, around the 2000 mark. In now a double top pattern, I'll try to post some more about that on the website, but basically you have the double top patterns contained in this range. We don't have exactly equal lows on these two reaction lows, but somewhere in there is the bottom of that double top pattern. What that means, if the prices were to break under this level here, then you would expect the pattern to drop by roughly the amount of the distance of the pattern from the top to the bottom of that range. So of course that would put us somewhere way down here. Now let's move over to the weekly chart, and you'll notice these uptrend lines that I have drawn on the monthly chart are now my primary uptrend lines on the weekly chart. Oh, let's jump back to the monthly. One thing I did want to look at here, something I've mentioned in the past, this is a ROC, or rate of change 12 indicator, which has done a really good job in the past of defining bull and bear markets. If you follow that vertical line up, it pretty much here is the bear market from 2000 to 2003, and we were in a bull market from this period here, and then the last bear market, and it would have got you in, yeah, not in the beginning. It's not an exact timing indicator. In fact, it's not a timing indicator at all. It's a larger trend indicator to determine if we're in a bull or a bear market, primary trend. And as you can see, we're teetering right now, right on the line. So what happens here in the next month or so could be help us determine if we're going to go a lot higher or a lot lower in the near term. Okay, back to the weekly chart. These are those uptrend lines that I had on the monthly chart. Zooming in here, of course, on a weekly time frame, every candlestick represents 1 week of price action in the market, and you can see this goes back to somewhere in 2002. All right, so let's take a look real quick at the last bear market, which officially broke that trend line around this point. If you notice this, the quick move down, that impulsive selling, trend lines are subjective. Everybody draws them different, views them different. Some people will say that's not an active trend line or a valid trend line, and agreed. There's many that I draw, and sometimes I don't see the reaction off those trend lines that I thought I would. But when I do see impulsive selling on a breakdown, that helps confirm or validate that that trend line was indeed trend line that was important in the market. So that's what we saw in this case. So from the peak here back in October of 2007, that started, if you can look closely, I know it might be hard on the scale of this chart, but there's quite a few candlestick tops, the wicks of these candlesticks that started that trend line right here, this highlighted one. And what you can see is after we bottomed down in the first wave on that bear market, and we had a nice counter rally, I'm looking at this level here. There was a key horizontal support, or which is now at the time a resistance level once it was broken. That was a level a lot of traders are watching, and you can see it really matches up nicely with a lot of either candlestick tails or bodies in this area here. And what happened, if you look here, you can see the wick prices did break above that level, and I remember it clearly because I was trading at the time, and that proved out to be a very vicious bull trap. When you see a breakout like that of levels that a lot of traders are watching, especially this one, you had a converging downtrend line, the key downtrend line from the highs, and that horizontal level both coming in together, which I'll talk a little bit more on. That's when we see the daily chart. That's what's happening now. Anyways, we got a breakout, and that breakout failed. We couldn't even close the week above there. That's why you see a candlestick wick, but the body is somewhere in here, meaning the price has shot through there and could not finish the week, fell back down, and then the reaction was pretty violent, which is often the case with bull or bear traps. What happens when you have these breakouts, a lot of traders are watching, so in this case you had a lot of longs jump in, because technically speaking the breakout is bullish. A lot of bears will cover their short positions, which adds further fuel to the rally, and once they realize that breakout's not going to stick, the bears just jump right back in, and you see the bulls running for the exits, trying to get out of their position. So something else to note on this chart before we move on to where we're at currently is this line here. This is a 40-week exponential moving average, the red line. I really like to watch the 200-day EMA exponential moving average on my daily time frames, and the 40-week moving average is the same as the 200-day moving average. And what I've noticed is that does a really good job also of defining uptrends and downtrends as far as the slope, meaning whether the line is pointing up or down. And you can see here throughout the bull market the slope was up, started to flatten out a few times, but never really went negative until shortly after the peak in October. So that, according to this indicator, that told us we were in bear market or downtrend primary downtrend territory from that point on all the way till down here. And like anything else, these aren't timing indicators, they are just something used to determine the overall trend. And as you can see, we've been in an uptrend since. It did flatten out, goes slightly negative here, and that's all indicators have their whipsaws. And but it didn't go down very sharply, and it didn't stay down very long. We had push back up here. This time around, we did have a much steeper drop. There's a pretty negative slope on the trend line there, or on the moving average. And although it is slightly curling up here, it's really too early to say. I would still view that as flat and indeterminable. So we'll see what happens. Again, the point I'm trying to make here tonight is we are at, I think, a very important inflection point. Whether we are going to, this will prove to be just a great correction in an ongoing bull market that we just experienced right here, or if this is indeed just another bear market rally, as this one was back and many have been before. So one other thing to cover, let's look at these. I don't know if you can make out these lines here, but these are Fibonacci time zones. I put these on some other charts earlier, so you can reference those. It just shows some important turn dates in the market. Now, moving forward, I'll go ahead and zoom in a little bit here, and we'll talk about where we are right now as far as the weekly chart goes. Here is our uptrend line off the March 2009 lows. Sort of formed a rising wedge pattern at the top, and we had a breakdown at this point, and prices came back up to retest that trend line or the rising wedge from underneath, which is common on breakdowns. And as usually happens, once we retested, we failed, and we failed pretty violently. There was a pretty sharp reaction off there. Came down, made a low, went up a little bit, made a lower low, and then here we are today. So that put us in to a downtrend, a breakdown of the primary uptrend, and from that point on, the market highs were back in, I believe it's May 2nd of 2010, if I'm not mistaken, was the day the S&P peaked out, and that's this point right here where the cursor is. So that started a new downtrend line, and you can see there's couple points there, a few close, very close, almost touches here, and where we are today. So this is a downtrend we're watching. Prices have pushed back up to it. The 200-day moving average or 40-week moving average is starting to curl up a little bit, but at this point it's too early to really say for certain that we are in a downtrend or an uptrend. We're going to have to see where prices go from here, but again, I do think we're at a pretty critical inflection point. Alrighty, let's take a look at the daily chart. Moving on, okay, this is a daily candlestick chart. Again, that last weekly uptrend line where I showed the wedge, this is the bottom of that line. And so this is basically a zoom in view, and I'll zoom in a little bit more here. You can see the breakdown that we had, the push back up to retest, and pretty violent failure. This was our high back on May 2nd. And that started a downtrend line from that point. We have this little doji here. I used to have this downtrend line drawn here. I actually missed that little candlestick earlier because I was zoomed out when I drew it. But once I realized it was there, this makes for a better trend line. Now I will say this: a trend line. What the definition of a trend line? It takes at least 2 points to make a trend line, 2 connecting points. But it takes a third to validate it. So right now, this is only the third touch of this trend line. So we can't put too much stock into this line yet. However, if we do see a reaction off this line, meaning prices turn down, even if there's a breakout for a day or two, let's see how the week closes. Because again, I'm going off these weekly charts, putting a lot of stock into those. This market has been full of trickery and fake outs, both on the long side and short side lately. So personally, I'm not going to be diving in head first on any longs until I see how this week closes, and maybe we follow through early next week. Nothing wrong with stepping aside if you're not sure of what's going to happen. Alrighty, if you'll note here, this was the lows that we had back in August and October. You see I drew this line, and if you look below, you'll see there was nice positive divergence set up on the MACD indicator as well as the CMF. That's another indicator I like to track. And that put in place a large bounce. I had identified support here at this level. Back at that time, positive divergence was in place. So from a technical point of view, this was a ripe setup for a bounce here, and we had quite a bounce. This was another trend line I was watching. You can see prices did react off this one quite a bit, and then we broke up through here. So now, again, this is where we're at today. A couple of red flags other than the ones I've mentioned recently. If you look down here, you do have negative divergence put in place on the MACD. I need to actually draw a line here so you folks can see what I'm seeing. Okay, from this point, in other words, where we closed today to this last peak, that is peak to peak divergence, negative divergence on the MACD. So that in itself is bearish. Now prices could push up and negate this divergence if the MACD goes higher. But we have divergences across the board on the CMF as well. And this is probably one of the biggest things I would point out here on the chart is the divergence on volume. We've had declining, and recently, especially on this breakout of this key level, this I thought was a key horizontal level here. A lot of traders would be watching, and we broke through it in the last 2 days, but on pitiful, well below average volume, and breakouts that aren't accompanied by above average volume are usually prone to fail, or I should say highly prone to fail. We'll see. Price action always speaks loudest, so respect that first. Volume is probably the second closest second most important indicator behind volume. Everything else is distant second and third. But again, let's watch for any breakout here. See if there's some volume starts to come into the market, or look for a reaction off this level, and go from there. Trade accordingly. I will highlight these Fibonacci time zones here, which again I've covered already in the blog. But if you look at the peak back in May, and you set the first Fib time zone to the trough down here on the first sell-off, it's, in my opinion, just amazing how well these line up. You can see this one missed the lows just a couple days past the low there. This one was exactly right on the low, which is at this point. And here we are today. Again, take a look at those on the site. And my usual disclaimer, I have not used these time zones much at all in the past and just started playing around with them recently, and was quite surprised to find out how many of the different time indicators lined up on various time frames, weekly, daily. Pretty impressive. So we have a cluster of time zones and things coming in around this time, so it is very possible they may predict an inflection point in the market here. But again, we have to wait to see what happens at these levels before we can bet this market heavy on the short or long side. Okay, that's about it for today. Thank you for watching, and if you have any questions, shoot me an email at randy@rightsideofthechart.com.